Level 1. First-time investor. You open a brokerage account on a Tuesday night. Nothing about it feels ceremonial. A form, a routing number, a small deposit. $500 moves from your bank into something that doesn't feel like a bank. The interface is clean. Green numbers, red numbers, charts that compress years into a line you can scroll through with your thumb. You buy your first share, not because you've done the math, because you've decided to start. At first, you watch the price the way you'd watch a spot, checking it in the morning, checking it before bed. It moves sometimes toward you, sometimes away. You don't know yet that the watching doesn't change anything. What changes is how you start to read the world. A news headline about a company you own lands differently. Now an earnings report means something. You start to connect what businesses actually do to what their stock prices eventually reflect. That connection is slow to form and easy to underestimate. You're not making real money yet. The position is too small for that. What you're accumulating is something harder to measure. A framework for thinking about ownership, value, and time. That framework is worth more than the return. Most people who start here quit here. The account sits. Life moves faster than the portfolio does. But if you keep going, something shifts. You stop treating the account like a lottery ticket and start treating it like a decision you made. And that is a different posture entirely. Level 2. Retail investor. You build a routine. A fixed amount leaves your account every month automatically without you having to decide again each time. Removing the decision is the point. You already made it once. The automation just enforces it. Your money goes into a structure now, not a single bet. A portion into an S&P 500 index fund, a portion into sector ETFs. A smaller portion into individual companies you've spent time researching. The allocation isn't arbitrary. Each position has a reason. The first real test comes when the market drops. Not a dip, a drop. Your portfolio is down 12%, then 15%. The number in your account is smaller than the number you put in. Everything you've read tells you to hold. Holding feels like doing nothing. But doing nothing is the correct action. And knowing that while your balance falls is harder than it sounds, you hold. The market recovers. Your cost basis on the shares you bought during the decline is lower than everything else in the portfolio. Dollar cost averaging isn't a strategy you read about anymore. It's something you live through. Your returns at this level are still modest, but your behavior has changed. You think in years now. You track allocation percentages, not just balances. You understand the difference between an account that's down and an investment that's failed. Most people never learn that difference. You have level 3, consistent investor. Your portfolio crosses $100,000. The number itself isn't the shift. The shift is what a percentage means. Now 1% is $1,000. A strong market year doesn't just feel good. It adds $8,000 to $12,000 to your net worth without a single additional contribution. Compounding stops being a concept and starts being something you can see in your statements. You set a formal allocation. 70% equities, 20% fixed income, 10% cash or alternatives. You write it down. When markets move and your allocation drifts, you rebalance back to those targets. You are trimming what has grown too large and adding to what has fallen. This feels counterintuitive. Every time you do it anyway. You start paying attention to risk-adjusted returns, not just returns. The question changes from how much did I make to how much risk did I take to make it. You look at drawdowns. You look at how different parts of your portfolio behave during the same bad month. Assets that fall together offer less protection than assets that fall separately. Tax efficiency becomes part of the strategy. long-term capital gains rates, tax-advantaged accounts, placing high turnover funds in retirement accounts, and holding long-term positions in taxable ones. These aren't dramatic moves. They add up slowly, the same way everything at this level adds up slowly. You're not trying to beat the market. You're trying to stay in it, stay rational inside it, and let time do what time does to compounding capital. Level 4. Advanced Investor. Your portfolio sits somewhere between $250,000 and $1 million. The work changes. You're no longer just building. You're optimizing what you've built. A 2% improvement in annual returns doesn't sound like much until you run the number. At $500,000, that's $10,000 a year. Compounded over a decade, the gap between an optimized portfolio and an unexamined one becomes very large. You add more structure to your asset allocation. Real estate enters the picture either through REITs or direct ownership. Alternative assets start to make sense as a hedge. Fixed income becomes more nuanced. Duration, credit quality, yield curves. You're not just diversified across companies anymore. You're diversified across how different assets respond to the same economic conditions. Tax loss harvesting becomes an active tool. When a position falls below your cost basis, you sell. Capture the loss to offset gains elsewhere, and immediately reinvest in a comparable asset. The position in your portfolio barely changes. Your tax bill does. You evaluate every investment on two axes now: expected return and downside scenario. The question is no longer just what happens if this works. It's what happens if it doesn't, and how large is that outcome. Protecting capital starts to matter as much as growing it, because you now have enough capital that a major loss would take years to recover from. Your decision-making becomes more systematic, less reactive. You are building a portfolio that can perform across different environments, not just good ones. Level 5. High Net W Worth Investor. Your investable assets cross $1 million. The financial system notices doors that were previously closed don't announce themselves as they open. You simply start getting phone calls from people you didn't know before. Private bankers, wealth advisors, introductions to opportunities that aren't listed anywhere public. The investments themselves didn't change. Your capital crossed a threshold and access followed. Private equity, venture capital, real estate, syndications, these don't trade on exchanges. They circulate through networks. Minimum commitments are larger. Holding periods run 5 to 10 years. Liquidity is limited by design. In exchange, the return potential is higher, but so is the risk. And there's no ticker to check every morning. You evaluate these deals differently than public investments. You're reading operating agreements, reviewing sponsor track records, modeling internal rates of return. A deal isn't good because someone presented it. You decide whether it's good. You start working with specialists, a tax attorney, a private banker, a financial advisor who works with clients at this level, not because you've outsourced the thinking, but because the complexity has grown past what one person can efficiently manage alone. Your portfolio now has layers: public equities for liquidity and growth, private investments for long-term upside, real assets for income. Each layer has a purpose and a time horizon. You didn't have that structure at level 2. You couldn't afford to. The challenge at this level isn't finding opportunities. It's filtering them. Because at $1 million in investable assets, you will never run out of people who want to put your capital to work. Level 6. Professional Investor. Your capital is now somewhere between $10 million and $100 million. Investing is no longer an activity that runs alongside your life. It is the primary function. A 5% annual return is no longer a percentage. It's $500,000 to $5 million. Every allocation decision carries that kind of weight, and you feel it, not with anxiety, with precision. You've built a process because you had to. Emotional decisions at this scale are expensive. Your portfolio operates across multiple distinct strategies: public equities for growth and liquidity, private equity for long-term compounding, real estate for income and inflation protection. Fixed income is balanced. Each position has a role. You know what the role is before you enter it. You may formalize the structure through a family office or investment entity. This changes how you manage taxes, reporting, and deal flow. It also changes how counterparties see you. You are no longer an individual investor. You are an institution of one. You benchmark your performance. You compare your public equity returns against the S&P 500. You track EAR across your private holdings. You measure whether your capital is being deployed as efficiently as it could be. Because at this level, the opportunity cost of poor allocation is real money in real time. Avoiding large losses becomes as important as generating large gains. A 30% drawdown at this scale doesn't just hurt. It takes years to climb back from. And the years you spend recovering are years you're not compounding forward. Level 7. Institutional investor. The numbers have moved past personal scale. You are allocating hundreds of millions, possibly more, through a fund structure, a family office, or an institutional vehicle. The nature of the work has changed completely. You don't spend time selecting individual securities. You spend time deciding how capital is distributed across strategies, how much into public equities, how much into private markets, how much into credit, real assets, or specialized funds. The allocation decisions are the job. Much of your capital goes through managers rather than directly into assets. You allocate to hedge funds, private equity firms, and venture capital funds. Evaluating a manager is its own discipline. Track record, team stability, strategy clarity, fee structure, alignment of incentives. A single commitment can be $50 million or $100 million. The due diligence has to match that. Liquidity is now a strategic variable. You can't exit a position quickly without moving the price or losing access. Capital is committed in tranches returned over years. You plan deployment over quarters, sometimes over years. Your decisions have downstream effects. When you commit to a fund, smaller investors often read that as a signal. When you pull capital, it's noticed. Information at this level travels through relationships, not headlines. You're part of a network of institutions, and that network shapes where money flows before the public ever sees it. Level 8. Billionaire investor. The frame shifts entirely. You are no longer managing a portfolio. You are making positions. A typical investment is not $50,000 or $500,000. It's $200 million into a single company, a controlling stake, a seat at the table where operational decisions get made. You are not buying exposure to a business. You are buying influence over one. Public markets still exist in your world, but they're no longer the center of it. The most significant capital you deploy moves privately. Direct deals, co-investments negotiated between principals, acquisitions structured over months before any announcement is made. By the time the market knows you've already decided, your transactions are visible in a way that creates their own gravity. When you take a large position, the market interprets it as a signal. When you exit the same, you cannot move quietly, so every move is deliberate. You enter when you're ready to hold, because the cost of changing your mind is priced into your exit. The people around you have changed. Your counterparties are CEOs, sovereign wealth fund managers, central bankers. Conversations that used to happen in conference rooms now happen over dinner. And the decisions made there predate any public announcement by months. At this level, the returns matter less than the influence over where the returns come from. You're not watching where capital flows. You are one of the people deciding where it goes. The market doesn't move you anymore. You move it.